Not having a properly structured IUL Index Universal Life strategy is what's hurting so many people. So I'm going to dive in on the importance of making sure it's structured correctly. You're here with Earl, the Money Coach. We're going to dive right into it, but make sure you like, comment, subscribe, and click below in the description for $150 to boost your credit and also get instant approval for $100,000 in loans. But let's get started. Properly structured IULs, Index Universal Life Insurance policies, comes down to using it as a overfunded strategy. When you have your IULs, you have a minimum amount and a maximum amount that you could put into your strategy. Most people, when they're talking to life insurance agents, they start at the minimum amount, better known as the target premium, but then they keep that target premium. They're not overfunding. So for this example, this hypothetical, I'm going to use a very simple mathematical IUL with the target premium being $100 a month and the guideline annual, the maximum being $1,000 a month. So you have $100 for your minimum target, $1,000 for your guideline annual, your max overfunded strategy. Now, first off, most people, when I sit down with clients who have an IUL strategy in place, they're just putting in the target. They're not overfunding. So when you hear your Dave Ramsey's and a lot of people out there that don't like IULs, I do say they are correct if they're not properly structured and you're not overfunding using it correctly. Because if you're just putting in that target, in essence, you're just putting in enough to keep the strategy going so it doesn't lapse. And what does that mean? You're pretty much paying for a very expensive term policy. So you want to make sure you have it properly structured and you're overfunding it to take care of everything. Now, why is this important? Because you know a lot of strategies. You might hear your 401ks, you might hear mutual funds, you hear a lot of these fees. You hear fees in all these strategies. But for insurances, there's no fees, but there's what you call a cost of insurance, a COI. Now, a cost of insurance has to be put in play to be able to keep managing that life insurance because ultimately it still is insurance. Even though you could use it for cash value, it still is insurance, which means as you get older, if you're not switching it over, and when I say switching it over, we'll dive into it later between have it as an increasing death benefit or a level benefit. If you keep it increasing, the cost of insurance is going to go up every year. The older you get, just like regular health insurance, the older you are, the more expensive it is. Same exact rules. If you have an increasing death benefit in your IULs, it's going to increasingly get more expensive, that cost of insurance. So at a time, I'll dive into it later, you need to have that switch. But understand you're going to have a cost of insurance and it's mostly going to be front loaded right up front. Now, how does that look? I'm going to use this hypothetical illustration. This is not what it is, but a hypothetical. Same $100 target, $1,000 guideline annual. Let's say hypothetically your cost of insurance is $1,000, meaning through the lifetime you're going to have $1,000 as your cost of insurance to have this one properly structured and properly funded so it can be self-sustaining. Now, let's just say that you have 10% coming out of what you're putting in monthly to cover your cost of insurance. So, what does that mean in this solution? If you're putting in $100 a month, 10% is what? It's only $10. Your cost of insurance is $1,000. How many months is it going to take you to pay $1,000 of that cost of insurance if you're just putting in $10 every single month? We're talking what? We're talking literally over 8 years just to take care of that cost of insurance because you're putting in the bare minimum. Now, like I said, you have a target which is 100 a month, and then you have your guideline annual which is 1,000 a month. So same rules apply. If you're putting in $1,000 a month, 10% is $100. Your cost of insurance is 1,000. So you see now how in 10 months, less than a year, you take care of your cost of insurance while you overfund. But it's going to take you over 8 years in this hypothetical if you're just doing the target. So a lot of times when you hear these people saying, "Oh, there's a lot of fees into your IULs," that is correct. If you're doing the target, it's going to take you a lot longer. So when you have a overfunded, properly structured index universal life strategy, you should be able to take care of that cost of insurance in the first few years. Generally speaking, it's about 3 to 5 years if you're overfunding a properly structured IUL. If not, now we're talking 12 to 15 years if you don't have it structured correctly and if you're just putting in the bare minimum. So realize that for the cost of insurance. And also, like I said, it goes up because you have what we call a level benefit and an increasing benefit. Breaking that down means this: you cannot have more cash value inside of a life insurance strategy than the actual face amount. So let's say if you have $500,000 in face amount, you cannot have over $500,000 of cash value. So that's why it's increasing, because the IUL will give you both the cash value and the death benefit. So you start day one at 500,000, but same scenario. If you got $500,000 of cash value and $500,000 of your face amount, it's going to show a total of $1 million. So that's why they say it's going to make sure you keep having it go up to make sure that you're covering the actual policy. But now the cost of insurance is when you have it increasing, if the face amount is continuously increasing, then the cost of insurance as you get older will continuously go up. So generally speaking, once you get to retirement, it could be 65, 60, whenever you decide on having your actual cash value start to come out, you want to switch your IUL from an increasing to a level, from an increasing death benefit to a level. So that way you stay locked in and it's not going to keep increasing. Then you start liquidating and taking that cash value out. Now, please understand, life insurance is not an investment. It's a supercharged saving strategy. It's kind of like a bond, something you could have where you're never going to lose money, but it's not going to be actually in the market, because life insurances, IULs, and a lot of those permanent insurances, they are a reflection of the market. So it's not in the market, it's a reflection of the market, but it still gives you an index. So if the market goes up, your money could go up to a certain percentage. But if the market goes down, your money stays locked in. So think of it as a supercharged saving strategy that you have to have overfunded. If you're not overfunding, it's generally speaking not going to work the way it's properly designed. That's number one. Number two, understand it's a supplemental income. Your IUL should not be your sole purpose of retirement. You want to have a mutual fund, have an IRA, have your stocks, throw in life insurance so you have different pools, different pockets to pull from for your actual cash value for your retirement. So you want to make sure it's a great substitution, is what a lot of people say. Oh, a 401k? No, don't get a 401k, got an IUL. A lot of people try to substitute an IUL from a 401k. No, I don't like considering IULs as a substitution. I like to add it as dividing what you have and diversifying your actual income. So you're not just pulling from all your eggs from one basket, you're diversifying from your life insurance as part of your retirement strategy. So you use a 401k, use an IRA, use your bonds, use your stocks, use your insurances. Pull from all these different things to be able to make a supplemental income, which means you're supplementing exactly what income you had while you were working, because the average person, they actually go down about 35-40% when it comes down to retirement of their actual income. Meaning if you've been making 100,000 a year, during retirement time it normally drops down to 60%. So how are you going to have a buffer? That's where IULs can come into play. So remember, IULs are great. They're not for everyone. You need to make sure you have it properly structured and using it for your scenario, because every scenario is different. Every life insurance is different, and every company has different perks. You might have long-term care as a perk, as what we call a rider. You might add on a long-term care rider, or may already be in there. You might have a living benefits. You have some IULs that have lifetime income you could add on. Different perks, different things for each company. So you want to make sure the right one could be used for you. If you want to know a little bit more, feel free to reach out to me about IULs, and we can either review your current IUL or see what could be properly used for yourself. And once again, make sure you like, comment, subscribe, click below. You could get life insurance right from my description, or you could get $150 to take care of your credit and also get approved instantly for $100,000 and up for your loans. So it's Earl the Money Coach, and we'll see you next time.